You use money every single day of your life. You earn it. You spend it. You save it. You worry about it. But here is a question most people have never thought to ask. Who actually decides how much your money is worth? Who decides whether borrowing is cheap or expensive? Who decides how much money exists in the first place? The answer is not your government. It is not your bank. It is not any politician you have ever voted for. It is a small group of unelected officials sitting in a building most people could not point to on a map. Today, Coin Explained breaks down the most powerful financial institution in the world, what it is, how it works, who runs it, and how its decisions affect every dollar in your pocket. What is a central bank and why does it exist? Let's start from the beginning. For most of the 1800s, the United States had no central bank. Banks were run privately. Each one printed its own money, literally. You could walk into a store with a note from one bank and be told it was worthless because the store owner did not trust that particular bank. The result was chaos. Financial panics happened regularly. Banks failed. People lost their savings overnight. In 1907, a particularly severe banking crisis nearly collapsed the entire American economy. The only thing that stopped it was one man, J.P. Morgan, the most powerful private banker in the country, who organized an emergency bailout using his own money and that of his wealthy associates. Congress looked at that situation and made a decision. They could not allow the financial stability of an entire nation to depend on one private individual being willing to step in. Something more permanent was needed. On December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act into law. The Federal Reserve, commonly called the Fed, was born. Its original purpose was simple: prevent financial panics, stabilize the banking system, and act as a lender of last resort when things go wrong. Today, every major country in the world has a central bank. The European Central Bank manages the euro. The Bank of England manages the pound. The Bank of Japan manages the yen. And the Federal Reserve manages the U.S. dollar, the world's reserve currency, used in the majority of global trade and held by governments everywhere. Which means the decisions made in that building in Washington affect not just Americans, but every economy on Earth. Who actually owns the Federal Reserve? This is the question that surprises almost everyone, because the answer is genuinely unusual. The Federal Reserve is not owned by the government. It is also not a fully private company. It exists somewhere in between, and that in-between status is the source of most of the controversy around it. Here is how it actually works. The Fed consists of 12 regional Federal Reserve banks spread across the country, in cities like New York, Chicago, San Francisco, and Atlanta. These 12 banks are technically structured as private corporations. Commercial banks in each region are required to purchase stock in their local Federal Reserve Bank as a condition of membership. So in that sense, private banks own shares in the Fed. But here is the important part. Those shares do not work like normal stocks. They cannot be traded or sold. They do not give private banks any control over monetary policy. And by law, the Fed's profits, after covering its operating costs, are transferred directly to the U.S. Treasury, not to shareholders, not to banks, to the government. The overall governing body, the Board of Governors in Washington, is a full government agency. Its 7 members are appointed by the President of the United States and confirmed by the Senate. The chair of the Federal Reserve is one of the most powerful economic positions in the world. Appointed by the President, but legally protected from political interference once in the role. In 2025, that protection was tested directly when President Trump clashed publicly with Fed Chair Jerome Powell over interest rate decisions. And the Supreme Court signaled that firing a Fed governor would be legally questionable. The Fed held its ground. The 3 levers that control your money. So how exactly does the Fed control your money? It has 3 main tools, and understanding them changes how you see everything in the financial news. The first tool is interest rates. The Fed sets a target for the federal funds rate. the rate at which banks lend money to each other overnight. When the Fed raises this rate, borrowing becomes more expensive for everyone. Mortgages go up, car loans go up, credit card rates go up. People spend less. The economy slows down. When the Fed cuts this rate, the opposite happens. Borrowing gets cheaper, spending goes up, and the economy picks up speed. The second tool is the money supply. Central banks can influence how much money exists in the economy through a process called open market operations, buying or selling government bonds. When the Fed buys bonds, it pumps new money into the banking system. When it sells bonds, it pulls money back out. More money in circulation generally means lower interest rates and more spending. Less money means higher rates and less spending. The third tool is reserve requirements, the rules that govern how much money banks must hold versus how much they can lend out. When banks can lend more money flows through the economy. When requirements are tightened, less money moves. Right now in 2026, the Fed's balance sheet sits near $6.7 trillion after peaking at $9 trillion in 2022. Core inflation has been brought down from over 5.5% to around 3%. Interest rates sit between 3.5% and 3.75%. Every one of those numbers is the result of deliberate decisions made by a small group of people in Washington. Decisions that ripple through every mortgage, every savings account, and every price tag in the country. How central bank decisions affect your everyday life. Here is where it gets personal. Every time the Fed raises interest rates, your mortgage gets more expensive. If you have a variable rate, the cost of a car loan goes up. If you carry a credit card balance, the interest you pay increases. Businesses borrow less, which can mean slower hiring and lower wages. Every time the Fed cuts interest rates, the opposite happens. Borrowing gets cheaper. House prices often rise because more people can afford mortgages. Stock markets tend to go up because investors move money from low-yield savings into higher return assets. And when the Fed prints money, or effectively creates it through bond purchases, the value of every dollar already in your pocket goes down a little. That is inflation, not caused only by central banks, but heavily influenced by them. Think about what happened between 2020 and 2022. The Fed injected trillions of dollars into the economy to fight the economic damage of the COVID-19 pandemic. The result? Inflation hit levels not seen in 40 years. The price of groceries, rent, energy, and almost everything else surged. The Fed then raised interest rates aggressively, 11 times between 2022 and 2023, to bring inflation back down. Millions of people felt those rate hikes in their monthly mortgage payments. None of those people voted for the people who made those decisions. That is just how central banking works. Is the Fed too powerful? The debate happening right now. This brings us to the most important question, and the one that is being debated right now in 2026. Is it a good thing that an unelected institution has this much power over the economy? The argument for central bank independence is strong. If politicians could directly control interest rates, they would almost always choose low rates, because cheap borrowing makes the economy feel good in the short term and wins votes. But artificially cheap money leads to inflation, which is effectively a hidden tax on everyone. Independent central banks exist to make the unpopular decisions that politicians won't. The argument against is also real. In 2025, former Fed chairs Ben Bernanke, Alan Greenspan, and Janet Yellen all filed a legal brief warning that political interference with the Fed would erode public confidence and damage the effectiveness of U.S. monetary policy. That brief was filed because the situation had become serious enough to require it. And there is a broader debate emerging, one that connects directly to everything this channel covers. If central banks can print money, set the price of borrowing, and influence the value of your savings, all without a vote, then what does that mean for financial freedom? Is there a better way? That is exactly the question that led to the creation of Bitcoin in 2009. A financial system with no central bank, no single point of control, and a fixed money supply that no one can change. We will get to that. But first, you needed to understand what Bitcoin was built to replace. The Federal Reserve is not a conspiracy. It is not a villain. It is a system built with real intentions to solve real problems that has enormous power over your financial life, whether you know about it or not. Now you know. Hit subscribe and turn on the bell. Every week, Coin Explained breaks down one more piece of the financial world in plain, simple language. Next week, why every country on earth is drowning in debt and what that actually means for you. See you there.